everyone, and welcome back to Financial Podcast. I'm your host, Olivia. Today, we're diving into a significant development in the ongoing trade discussions, specifically concerning the United States and the European Union. President Donald Trump recently announced a delay in the implementation of a threatened 50% tariff on goods imported from the European Union. This is a notable shift from his earlier stance and has implications for global markets and trade relations. The proposed tariff, a substantial 50% levy on EU products, was initially set to take effect quite soon, specifically on June 1st. This threat had stirred considerable concern and uncertainty across financial markets around the world. Such a high tariff could significantly impact trade flows and consumer prices for European goods entering the U.S. market. However, President Trump has now agreed to push back this deadline. The new date for the potential implementation of this 50% tariff is now July 9th, 2025. This extension, according to reports, was agreed upon after a conversation between President Trump and the President of the European Commission, Ursula von der Leyen. The call between the two leaders took place on Sunday. Following this discussion, President Trump described the call as very nice, and it indicated that he agreed to the delay based on von der Leyen's request. According to President Trump's retelling, von der Leyen expressed a desire to engage in serious negotiations and stated that European officials would rapidly get together and see if we could work something out. President Trump also shared his perspective on the extension via social media, stating that he agreed to the delay until July 9th, 2025, and considered it his privilege to do so. Similarly, von der Leyen characterized her call with President Trump as good and emphasized the importance of the trade relationship between the EU and the U.S., noting that it is the world's most consequential and close trade relationship. She affirmed that Europe is prepared to advance talks swiftly and decisively, and that the time until July 9th is needed to reach a good deal. This delay comes after a period of heightened tension regarding trade between the U.S. and the EU. Just a couple of days before the delay was announced, on Friday, President Trump had publicly threatened the 50% tariff on EU goods. At that time, he had voiced frustration, stating that the 27-member bloc had been very difficult to deal with on trade matters, and that negotiations seemed to be going nowhere. In fact, on Friday, he had even indicated he was not looking for a deal, saying, "We've set the deal, it's at 50%. This shift in tone following the call with von der Leyen appears to have smoothed over tensions, at least temporarily. It's important to understand the context of this latest development within the broader trade policies pursued by the Trump administration. Last month, an initial 20% tax had been announced on all EU goods as part of what were termed Liberation Day tariffs, which were also placed on nearly every country. Shortly after this initial announcement, there was a pause on reciprocal tariffs for 90 days, leaving a 10% blanket tariff in place. European manufacturers have also been facing a 25% tariff on steel and aluminum imports to the United States. The now delayed 50% tariff threat significantly escalated these measures. Treasury Secretary Scott Bessent offered some insight into the administration's strategy behind these threats. He mentioned that President Trump hoped the recent 50% tariff threat would light a fire under EU officials during trade talks with U.S. negotiators. He also indicated that President Trump believes that the proposals put forth by the EU have not been of the same quality as those seen from other important trading partners. This suggests that the tariff threat was intended, at least in part, as a negotiating tactic to pressure the EU into offering more favorable terms from the U.S. perspective. The announcement of the initial 50% tariff threat had a clear impact on financial markets. Following the threat, markets dropped sharply. The S&P 500 fell, the Nasdaq Composite sank, and the Dow Jones Industrial Average dropped. This market reaction underscores the sensitivity of global finance to trade tensions and tariff threats. However, the subsequent announcement of the delay appears to have brought some relief. Early on the Monday after the delay was announced, European shares gained ground. Futures for the S&P 500 and the Dow Jones Industrial Average also advanced. In Asian trading, indices like Tokyo's Nikkei 225 and Seoul's Kospi climbed, although Hong Kong's Hang Seng and the Shanghai Composite Index saw losses. The impact extended to individual companies as well. Apple stock, for instance, dropped by 3% and was a significant drag on the S&P 500 after President Trump mentioned he had been urging Apple CEO Tim Cook to move iPhone production to the United States and warned of a tariff of at least 25% if production wasn't moved domestically. Other companies also felt the pressure from the overall economic uncertainty linked to trade policies. Deckers Outdoor, the company behind popular brands like Hoka and Uggs, saw its stock shed nearly 20% after it decided not to offer financial forecasts for the upcoming full year due to the uncertainty. Similarly, Ross Stores fell significantly after pulling its full-year financial forecasts, citing that over half of the goods it sells originate in China. This highlights how companies with significant international supply chains are particularly vulnerable to fluctuating trade policies. On the other hand, some sectors and companies saw gains. Intuit, known for products like TurboTax and Credit Karma, rose after reporting a stronger profit than expected for the latest quarter. Stocks in the nuclear industry also rallied after President Trump signed executive orders aimed at speeding up nuclear licensing decisions and other measures intended to boost the industry. For example, Oklo, a company developing fast fission power plants, saw a significant jump in its stock price. The broader context is that Wall Street had previously recovered most of the losses incurred earlier in the trade war. The S&P 500, at one point the previous month, had dropped significantly below its record high when worries about the tariffs causing a global recession were at their peak. However, the index had climbed back closer to its all-time high after President Trump paused tariffs on many countries, notably China. This suggests that markets react positively to de-escalation or pauses in trade disputes. Currency markets also reacted to the news. On the Monday after the delay, the euro edged higher against the US dollar. Gold prices, often considered a safe haven asset, fell as the demand for such assets lessened with the reduced immediate threat of the 50% tariff. The decision to delay the tariff until July 9th is intended to provide time for negotiations to yield results. The European Commission spokesperson indicated that the U.S. and EU trade representatives were scheduled to hold talks shortly after the announcement of the delay, describing a new impetus for the negotiations. Both sides agreed to fast-track the trade negotiations and maintain close contact. German Economy Minister Katharina Reich also commented calling for tariff negotiations to proceed calmly and emphasizing the need to find a common path. However, despite the temporary relief and renewed focus on talks, some experts and market observers remain cautious. While it's possible a deal could be reached by July 9th, some question how much the fundamental problems underlying the trade dispute have changed simply because of a phone call. The feeling is that the brief respite from the most severe tariff threats might only be temporary given the unpredictable nature of the situation.
The negotiations themselves have faced challenges. According to reports, they had been stuck, with the U.S. demanding unilateral concessions from the EU to open up its markets to U.S. businesses. In contrast, the EU has been seeking an agreement where both sides would benefit. This difference in approach has contributed to the difficulties in reaching a resolution. The potential consequences if the 50% tariff were to be implemented remain significant. This levy could raise consumer prices on a wide range of European imported goods, from high-end cars manufactured in Germany, like BMWs and Porsches, to products like Italian olive oil and French luxury handbags. Such price increases could potentially hurt demand for these goods in the U.S. market. There was also some lack of clarity on whether the 50% threat would apply to all EU imports or only those already subject to the existing U.S. reciprocal tariff, which currently does not cover products already subject to other investigations, such as steel, cars, semiconductors, pharmaceutical products, and lumber. This ambiguity adds another layer of uncertainty. Businesses, particularly those in Europe, remain on edge due to this volatile environment. Even with the delay, companies like Germany's Lapp Group, which produces cables and robotics, warned that some of its specialized products might still be affected by tariffs and expressed concern about the unpredictability
individual interests and populism perceived in current U.S. politics. The CEO noted that confidence in the stability of Germany's transatlantic relations, built over decades of diplomatic work, is suffering damage. Another point of uncertainty mentioned in the sources is the White House's earlier vow to reach trade deals with 90 countries in as many days, following the initial pause on reciprocal tariffs. Experts have publicly stated that, quote, there is no way the administration can achieve this ambitious goal, highlighting the difficulty and complexity of rapidly concluding comprehensive trade agreements. This broader context suggests that while the focus is currently on the EU, the U.S. trade agenda is wide-ranging and facing significant challenges on multiple fronts. In summary, President Trump has agreed to delay the threatened 50% tariff on European Union goods from June 1st to July 9th. This decision followed a conversation with European Commission President Ursula von der Leyen, who requested the extension to allow time for trade negotiations. Both leaders described the call positively and expressed readiness to engage in swift talks to reach a deal. The initial tariff threat had caused market turmoil, but the delay brought some relief to European markets and currencies, although underlying uncertainties about trade relations and the potential for future tariffs persist. The situation continues to be fluid, with businesses and markets closely watching the progress of negotiations. Thank you for tuning in to Financial Podcast. I'm Olivia, and I'll keep you updated on this and other important financial news. Goodbye for now.